Yeah. Okay, we need to move along here.
Sure.
What is a deferred exchange and what is a simultaneous exchange?
Pretty straightforward.
Good.
The most common simultaneous exchange is a car trade-in. So let's say I have a car, I'm a traveling salesman, and I have a car and I use it exclusively for business, for the most part. I run up the miles, 200,000 miles, and I take it into the dealer and I say, I need a new car. It's all worn out, so I'm going to give the car, and the same day they deliver my new car. That's a trade-in. That's in a 1031 exchange because I've given the thing. It happened at the same time.
Okay.
Non-simultaneous exchange, typically in the real estate context, is what we've been talking about, where the taxpayer will sell property in one independent transaction and then later buy property in another independent transaction, provided, however, that the taxpayer in the first transaction follows a regulatory scheme that's provided in 1031 regulations. It says, I'm not really selling, I'm hiring a third party, so-called intermediary, that's what I do partly for my job, to hold the sales proceeds. And so what happens on that $1 million example is I have a $1 million sale, the $1 million net proceeds goes to the qualified intermediary who holds it frozen, said to be beyond my constructive receipt, beyond my control, and the only use for that money is to go over here and buy this other property for $1 million. And so therefore the funds flow beyond the taxpayer's control, and that's said to be an exchange. And that's the basic facts of the Starker case.
Okay. Let's see here. So very briefly, what is a reverse exchange?
Reverse exchange.
Briefly. Right?
So do you have, how many?
Where's my chart? Yeah.
How many hours do we have, right?
Yeah.
Well, actually, let me take a step back from it. In 2000, the IRS actually approved this, so it seems a little screwy, but the IRS actually has a safe harbor, so that if you follow their safe harbor,
right.
You will get tax avoidance on your so-called reverse or parking exchange. And there's actually two types of so-called reverse or parking arrangements. Now, in a pure reverse exchange, what happens is that I've got a property that I wish to sell for whatever reason. So it's worth $1 million. I either I don't need it or I don't want it, but it doesn't fit my suitability at this point. And I do want to sell it, but I don't want to pay the tax because I bought a long time ago for 100, so I got a big gain. Now, my real estate agent calls me up and says, you know that property you've been looking at for years, that one on the corner of Santa Clara Street and somewhere up the street? It's going to be for sale. They're going to have the bids put in tomorrow. It's a very hot property. It's $1.5 million is sort of the asking price. And you think to yourself, well, I'd love to sell my $1 million property and buy the $1.5 million one, but how can I get rid of this first and go into that? You can go buy the $1.5 million, provided you can pay, of course. You can go buy that and park it with the intermediary, with what's called the title holder, accommodation title holder. So you park that property, and you have up to 180 days to sell the desired relinquished property. Okay, so you're doing the transactions in reverse, and that's where they get the terminology.
Okay. Now, we sort of get into a little bit of the nitty-gritty. What are the requirements for identifying a replacement property?
Okay, so let's take a step back and really understand what this is. The most common transaction for 1031 exchange is the non-simultaneous, the so-called deferred or delayed.
Right.
From the date that you sell the property, you have 180 days to buy the replacement property. From the date that you sell the property in a forward type exchange, you have 45 days to identify one or more properties. There's certain limitations, of course. And the properties that you identify are intended to be replacements for the property you gave up. So today is June 15th. 45 days from today is July 30th. So on or before July 30th, if I close today, today's day 0, 45 days, July 30th, if I'm the taxpayer, I have to identify in writing up to three, generally, alternative properties by writing a letter to my qualified intermediary. And if I write a letter and I identify these specific properties, those properties become eligible for the replacement property of the property that I'm giving up today. Okay?
Yeah. And then it has to be done, then they'll closed within the 180 days.
Within 180 days starting today, so my example, I'm going to wing it. I'm going to say December 12th. It's not 6 months.
Yeah.
It's 180 days.
Right. And then the other thing related to this is sometimes we have to deal with tax return due dates.
Correct.
So it's the earlier the 180 days or the tax return due date. So you may need to file an extension.
Right. For calendar year taxpayers that start their exchange after October 15th, and they wish to have the full 180 days, they're going to need an extension on their Form 1040.
Okay. So you talked about it a little bit already, but what is the role of the qualified intermediary?
Qualified intermediary is described by the regulations. It's the so-called accommodator or a straw man. So what happens conceptually in a transaction, in the sale of a relinquished property, if the taxpayer sells the property and controls the money, there will be a taxable event. So the regulations are designed to allow a taxpayer to hire this so-called qualified intermediary to hold the sales proceeds, and if that occurs in the right way called out by the regs, then you have a gain avoided, you have a non-taxable event, provided, however, the intermediary uses that money to buy the replacement property on the other side.
Okay. So we're getting pretty close to being out of time here, but there's an important development related to this intermediary stuff that I think we should talk about in our show today, and that is what happens when the intermediary goes bankrupt.
Yeah,
and so now they can't finish the exchange.
Well, it's quite possible. IRS has issued guidance, the Revenue Procedure 2010-14, on how you report, if your exchange fails because of that, how you report. So that's the good news, is there is a reporting mechanism and so forth. It doesn't really differ from what we thought before. But if they go out of business, you really lost the money.
Right.
And that's really the important thing, to know who your intermediary is. Now, the state of California, in light of some of the problems in the financial markets, has established some rules to safeguard taxpayers' monies with intermediaries. So we're required now to have a secured bank account with taxpayer control that meets the federal rules as well.
Okay. But the bottom line is that you don't have to report income on the cash that you didn't receive.
Well, that's not necessarily true, and because we have only a few minutes here left, it's going to be very difficult. Yeah. Okay. So I think that we should reserve that for the taxpayers. Prepare.
So see your advisor. There is some help there, though. That
or
a lot of people.
If anybody wants to contact me, I can sort of walk them through it, whatever.
Okay. So we only have about a minute left, so maybe there's a final word of wisdom that you'd like to throw out.
Basically, anybody thinking about doing an exchange, I always say, where are you going? So many times people come to me and they say, well, we're closing a deal today and we want to do an exchange. And I say, well, have you thought about what you're doing? No, we're going to go shopping for a property next. 45 days is a very limited time. And a lot of people run out of time, and then they end up buying they buy a bad property to save taxes, but they really make an economic mistake. So I say, know what you're going to do ahead of time before you actually enter into it.
I had a real estate investor friend. He always used to say, know what you're going to buy first before you sell your property.
Amen.
Okay. We're all out of time. So, Scott, I want to thank you again for being with me for this show. Folks, be careful out there with this deferred exchange. Get some advice. But it can be helpful because you can have a big tax bill when you sell these things. And I hope we'll see you next time on Financial Insider Weekly.